Now, understand how business actually works upon. We discussed that how solvency ratios provides the basic foundation. So you can see of this diagram, break a business into these four parts. That's how you need to understand now. I don't want you to just calculate these ratios and move on. That's not the agenda of this training. And I cleared that in the beginning itself. You need to start thinking in that manner. So whenever you see two balance sheets or P&L account, just start thinking breaking up of the business. How you'll break up any business. This is the most important part that we are going to learn right now. You need to break up business into these four parts. Any businesses has these four parts. The first part is the business foundation. What's the foundation of business? Second part is after foundation that will come is the efficiency. So you can see this is the base, this is the foundation. These are pillars, these are operating efficiencies, these are business efficiency. After that, this comes the liquidity that provides money through all the pillar, right? So that's liquidity part of the business that comes up here. And finally comes the profitability part of the business. Now you can understand that if the foundation is solid, the company is operating effectively, efficiently, and the liquidity position in the medium term is good, then as a result, company is bound to give good profitability ratios. That's usually, in maximum cases, if these three are good, you will find good profitability ratios. However, there are certain exceptions which have the talent that even after operating efficiently with solid foundations and solid liquidities, they are not able to generate profitability. So there is some serious problem with those businesses. So if someone asks you about any business, you should have four think into the business. How the foundation of business, how is the operating efficiency of the business, what is the liquidity position of the business, and what is the profitability position of the business. Now, for example, in the DuPont analysis also and in the solvency ratio, we understood that financial leverage is harmful. It's a two-sided sword, right? So this will make the foundation weak. So let's assume that the company had good amount of financial leverage. It was operating efficiently, meaning that all the activity ratios, the fixed asset were able to generate good sales. Then we are able to collect our receivables in a timely manner. We were able to delay the payments up to some extent. And the liquidity position in the short term was good enough and rotating among these pillars. So as these pillars get their desired fund at the requirement time. As a result of which the profitability is also good. Operating efficiency good, liquidity good, profitably, but there was a problem in foundation that it was built on high financial leverage. Now that's a problem for me because we understood that how it can kill a company. So any bad year that will come upon in the company, for example, see in the current year, like the virus situation or any other down cycle slowdown, what happened is that this small crack gets bigger. This small crack will get bigger, and once it gets bigger, you know what will happen if a foundation of any building gets out. These pillars will eventually fall upon. So these pillars will then fall, as a result of which this will now become very doubtful. And if these all three things are going bad, this is bound to go bad. You will not be able to generate good profits. You will not be able to generate good ROA in that business because now the entire base has been collapsed. Efficiency collapsed, foundation collapsed, liquidity collapsed. So how this is the end result. That's what these arrows are signifying. That if these three combinations are good, this will be good. So whenever you are now looking at any company, for example, the current company on which we are making the model, you need to start thinking in that manner. So these ratios, I'll again repeat it, take these ratios very seriously. I've seen people who doesn't take this seriously, will just calculate while making a financial model. They'll simply calculate, put some number, put the number, numerator, denominator, they'll move on. That's not a business understanding, and that's not how you'll develop an equity research habit. You need to ask the right questions, and these are the right questions. By the way, you will not find this in any other course, booklets, curriculums, the way you need to look up all these together, you will not find it anywhere else. These are like my personal experiences that I've gained over the period that now I use when I am analyzing any company for my investing and trading purposes. So first I ask the foundation, then I see the efficiently, then I see the liquidity and profitability as a result of all these three. If you understand these four things, you are actually now able to read P&L and balance sheet. So many people just keep saying around, you need to understand reading P&L and reading balance sheet. Come on, those just numbers won't give you anything. This is how you need to break it up, and then only you're able to read the entire business from the base to the pillars to the roof. This is roof. The base, pillars, roof, end outcome. End outcome is money, right? Greenery. Green is like, stock markets also. Green is signifying increase in profits. So that's why I put it the color green up here.